Joining us with the bull case for Meritage Homes is Stephen Kim, Homebuilder sector analyst with Evercore ISI. Gentlemen, it's great to have you. And Ken, why don't you kick things off here?
Thank you for having us. Just to set it up, in contrast to our prior bear thesis, we think the stocks in general have largely de-risked versus the market for now. And that's consistent with our RIP framework, which uses data since 1962. And the key point here in a highly correlated group and how we avoid being permeable, we use a quantitative framework, avoiding adjectives and longer term factors like demographics, supply, that really miss a lot of the stock catalysts. So the book value is de-risked versus the market, pressure on earnings and the multiple. We like Lennar for three reasons within our framework. It has a high trailing return on inventory, has a low net leverage versus peers, and it's that simple that it's a relative call. It's been working, but we do think, as today highlights in the market, there's a lot of sensitivity around rate forecasts.
No, I would never think of you as a permeable, Ken, because the last couple times we spoke in prior months, you were much more bearish. And if I recall, you always said, don't buy the builders until the Fed tightening cycle stops. So is that implicit in your call here and in your bullishness that you think we're basically at the end of that cycle?
Good memory. We have changed the nuance of the call as many of our investors, PMs, really try to outperform the S&P. Our analysis back to 1962 looked when the group's risk versus the market largely abated versus the overall cyclical return. So the timing of the market we've, in terms of the absolute stocks, avoided by reflecting the investment process of our clients.
Okay, so again, to be clear, you are a bull on Lennar. And Stephen, you are more focused on Meritage. Do you also like Lennar, or do you think that Meritage is much more attractive here, and why?
You know, I sure do. I sure like Lennar as well. In fact, I think Ken's going to look real smart here in about 3, 6, and even 12 months out if he keeps his call. We actually have probably a higher target price than Ken does actually on Lennar. So I absolutely agree with what he's saying on Lennar and the group in general. I will say though that when a group like when a group like the Homebuilders comes into favor, a lot of times it's some of the smaller cap names that get maybe a little overlooked, and they can actually have bigger moves. And so Meritage is one that I do think has a lot of virtuous qualities. A lot of the things actually that we like about Lennar, for instance, very low leverage, high profitability, a business model that goes for affordability and does spec building with a focus on efficiencies. These are all things that these two companies share. What's different, though, is their valuations. Meritage trades at a significantly lower valuation. It trades below its book value. And as a result of that, when this group, we think, comes into its own in 2023, we think that Meritage will probably have a bigger move. So I have an over 50% return potential over the next 12 months that I'm projecting for Meritage.
Stephen, it's Dom here. I wonder if you could tell us, I mean, Lennar and Meritage aside, or maybe included, we know that home builders, by their very business, are geared and more levered towards the interest rate market, right? But I wonder if you could tell us and our viewers which home builders in your coverage universe are more sensitive to interest rates than others on a relative basis.
I don't actually believe that there is a significant difference for most of the builders. I would say perhaps Toll Brothers might stand out as one that is less sensitive to interest rates just by virtue of their luxury buyer. That being said, I think that what the problem is that has been sort of keeping the valuations on the builders depressed is this general overarching concern that home prices across the country are going to go down something on the order of 20 or more %. That is something which is, in our view, not going to happen. I've been pretty clear that I think that is not in the cards. And that's been an area of disagreement, we believe, for the group. So as 2023 comes into view and we think that it becomes clear that you're not going to see that, we think this whole group will benefit. And a key part of that, of course, is going to be mortgage rates. I would point out, Dom, that the spread of the 30-year mortgage rate over the 10-year yield is incredibly wide and could easily contract 50 to 100 basis points and still be above normal. that would bring your mortgage rate into a 5-handle territory. And I think housing demand would really rebound well in the spring if that were to happen.
That's exactly what Diana and I were talking about last hour, although I don't know if QT interferes with those prospects.